All right, so let's begin. All right, so thank you all for joining. We're excited to host our 6th virtual roundtable. And these roundtables are a great opportunity to meet other members, share our knowledge and insights, and hopefully walk away with some new ideas and connections. So with the recent economic events, we wanted to do a two-part series on personal finance strategies. And this is the second part of that series. So the first thing we like to do is start with member introductions. So I'd like to invite everyone to share their name, what they do for work, and what their investing background is, and maybe something interesting about yourself. Why don't we go down the list and start with Jerome.
Hey, yeah, thanks. Thanks for inviting. This is my first time. I am new to the group. So my name is Jerome. I grew up in the Bay Area. I've been working in IT for the past 10 years. I've started investing, at an early age. I guess it wasn't investing, it was more of saving. And then last year is when I got introduced to trading, day trading, swing trading. And it was just until the beginning of this year in January where I was actively trading every day. So I'm relatively new to day and swing trading, and just really interested in meeting other people within this group. So yeah, that's a start.
Great, thank you. And next up we have Tremaine.
Hey, I'm Chinmay. I'm from Jersey City, New York City. I work in New York City as a software engineer in ad tech. And in my past, I worked in embedded software, finance, trading, and now ad tech, a lot of number crunching and data science kind of stuff. And I've been investing in stocks for the last 11 years fairly successfully, and just getting into real estate. Yeah.
Awesome. Thank you, Jermaine. And next up we have Gene.
My name is Gene, real estate agent doing commercial and residential in the Bay Area. And investment-wise, residential real estate, I do developments on the side. Oh, not on the side. I do development pretty much full time. But anyway, anything interesting? I love cars. I mean, yeah, I do run through them more than some people like girlfriends. I love cars. That's it. Yeah.
All right. With that, let's go to Greg.
Hey everyone, Greg Iwahashi. For business, I do business development for Proterra. It's an electric transit bus manufacturer as well as battery manufacturer. Before that, I was doing stationary storage development of batteries at NG, which is a large utility independent power producer. So utility, clean tech background, just got into EVs, I would say, for the last year and a half through Proterra. In terms of investing background, pretty new to it, I would say. Just kind of invest in some stocks that I'm familiar with regards to company financials. So a few clean tech stocks here or there. Otherwise, honestly, just doing index funds for the most part, and really looking to understand a little bit more about some other avenues to invest in or different ways. For work, at least, I've done some financial models, other things with regards to like project development for power plants, but a little bit different for personal, especially on the dollar amount. But yep, looking to learn more.
Awesome. It'll be awesome. It'll be great to be able to invest with their budget. All right.
Capital.
That's a massive capital. All right. And now we have Yang.
Oh, hey guys. Yeah, I'm Yang. I live in San Jose. I work at Intel in pricing. Investment wise, I'm pretty risk averse. Most of my investments are in like ETFs and broad market funds, 401k, that kind of stuff. I have some real estate in Sacramento, which is where I was born and raised, or actually raised but not born. And in terms of, I guess, what I would like to get out of this is, I feel like one of my major flaws is I tend to, like, if I'm holding on to a certain stock, I tend to get out pretty easily. I think part of that is because I'm kind of risk averse. And so, like, if I see, hey, I've made some money here, maybe it's time to let go. So I think it has to do with the risk averseness of myself, my personality, but also I don't put in as much time to really think through and look through the financials. So that could be one of the downfalls of why I do that. So I wanted to hear your guys' input and discuss what strategies you guys have.
Great. Definitely want to discuss that during this conversation. And thank you for joining, Kim. Would you like to make an introduction for yourself? We're sharing our name, what we do for work, and our investing background.
Hi, my name is Kim Marissa Zabel. For work, I'm a respiratory therapist. Investing background, I've done mainly a lot. I started off with single family, but have now actually gone into small multifamily. So we have some in California, and then we also have some in the Midwest. Hello, everyone.
Great.
Sorry, a little late. I got off of work late. Apologize.
All good. And where are you joining us from, Kim?
From Stockton, California.
Okay, awesome. All right, and now we have Ken.
Hey, what's up, guys? Sorry, I stepped away from the desk for a little bit. Quick intro from me. I am one of the, co-organizers with Sam on the AIN. My background is I've spent over nearly 2 decades in technology, both in consulting and startups. Right now, actually, I've started a new venture focused on medical services, so essentially back office and front desk services. My background is actually I invest through a series of angel investment groups. So I focus on software as a service, cloud computing, a variety of tech, and then as well, I also have a pretty strong point of view on investments in terms of equities. I'm dipping my toes further right now in real estate, so obviously hope to hear some more perspectives on that. So yeah, that's a short of it.
Awesome. Thank you, everyone. And I guess I would do the last introduction of myself. And my name is Sam. I'm from the Fremont in the San Francisco Bay Area. I work in private equity in commercial real estate investing for high net worth individuals and family offices. When we invest in commercial real estate across the US, everything from multifamily to office, industrial, retail, you name it. So aside from that, I also invest in properties around the San Francisco Bay Area. I buy properties and renovate them, and I also buy commercial properties for cash flow. And something interesting about me, I love to travel. I've been to 40 plus countries. Would love to go again once things are safer. All right, shall we get started in our discussion? So we have a couple prompts that I want to share with you guys and see what you thought. So the theme of this is basically, your strategies for personal investing and personal finance. And the last discussion we discussed what drives us to make an investment. Like, how do you determine what investment you're going to make? And one theme that we came across was that everyone had to have a strong conviction. I believe Yang mentioned this, that he exited investments quickly because he's risk averse. But one thing that may counteract that is if you have a very strong conviction on your investment thesis and why it makes sense, then you can stay with that thesis and write it out and execute the full plan. So with that preface, I wanted to just throw it out into the room. What sectors or investments do you have a strong conviction on? Who would like to start?
I can go. So I work in technology, so I obviously have a very strong conviction about technology. Over the past, as long as I've been alive, and I've understood things, I've seen technology become a part of every single sector, even the ones that you could not imagine 20 years ago, say like medical, shops, you go to a small mom and pop store, they will have a Square device to check you out. Even in other countries that I've traveled to, which by the way, I love traveling, I miss it. But every country is adapting to technology and basically bringing technology into their own way of doing things culturally. So I'm from India, credit cards, for example, are not very prevalent there. People don't trust e-commerce or trust online payments as much, not e-commerce. So we've come up with a way to still use technology and barcodes to basically do face-to-face transactions with money rather than doing Amazon, so over here you pay with your credit card on Amazon. Over there, you basically do an Amazon transaction. Someone shows up at your doorstep with the merchandise and you can pay them in cash. So this is how countries that are not, haven't been doing technology for a long time or are culturally not kind of averse to it are still buying into tech. So tech is one thing that I have a strong conviction about. I look at which companies have an edge, what are they doing, which companies can benefit from more proliferation of technology into their business or into other businesses. So that is how I choose to invest in tech companies. And a strong trend is obviously e-commerce. People want to buy stuff all the time. They have to buy stuff. I work in online advertising, so I know the world is in the business of trying to sell you stuff. So people are going to buy stuff, and who is facilitating that? So e-commerce is a thing. We have great examples of Amazon, Shopify. We have Mercado Libre in South America. China has its own Alibaba, and Tencent is, well, they own Weibo, right? So there's that. Africa has Jumia, Jumia, or JMIA is the ticker. So e-commerce is another trend. Another strong trend that is I have conviction is clean energy. So I try to pick who is going to actually this is clean energy is still new and it's hard. So I try to pick companies that are going in fields that I feel that will become big. For example, electric and the areas where battery technology and electric is solar. I feel like they're definitely going to be winners. It's easier to pick there, but clean hydrogen is one area that I think is going to be a thing. Clean water is going to be a thing. So those are the areas that I generally look into, clean energy, technology, and e-commerce is where I have conviction. And the way I look at it is how much risk do I want to take of losing money as today as against losing a lot more tomorrow? Am I willing to risk losing 10,000 today to make 100,000 in 5 years, 10 years? That's one of the ways I look at, one of the things I look at to decide whether I want to go with a risky investment or not. Numbers, of course, vary depending on what I'm looking at, but that's generally how I look at things.
Awesome. That's a fascinating perspective. I especially liked how you shared the story of how India incorporates tech into a society that doesn't really trust online transactions. I think that there has been a lot of opportunity over the past, say, 20 years of countries or entrepreneurs in different countries adapting what works in other faster moving countries into their own societies that are not as willing to accept the change. A quick note on that is I saw a almost exact replica of Costco in the Philippines, and it was extremely successful. And everyone had no idea what Costco was, but everyone knew what SNR was, which is the exact carbon copy of Costco, down to the pizza and then the chicken bakes. So that was really interesting. Awesome. Anyone else like to share or have something to chime in? I know Jean and Ken, you both have strong opinions on your convictions.
Hey, this is Ken. I'll chime in real quickly. Yeah, I think so. I love that conviction is the word of the month or the word of the I guess the year even. I think in this investing environment, it's important to have a long view. And reflecting what Chinmay had just brought up, I think Mark Andreessen, who famously started A16Z, or Jason Horowitz, that venture capital firm that everyone probably has heard of in some form or fashion, famously said that technology is eating the world, and well, actually, software is eating the world, which to a certain extent is true, especially if you observe the way software companies get valued in both the public and private markets. As I mentioned, I do investing through a fund called ARC Fund, where we look at a variety of startups that not just are focused on software, but also, it's as diverse as like some, augmented reality to food even. And if you just look at the observations of the valuations there, you go from something with food, which has a multiple about 5 or 6, to software, which could be a 20 to 100x. And the reason why is because it has what's called operating leverage. So I mention this because it's the foundation upon which I look at all my public sector investments. I have strong convictions in basically 5 platform, I like to call them seismic shifts. They're not new, it's not rocket science, but it takes a little bit of research and understanding to understand how they're shifting human society, how we pay for things, how we learn things, how we connect with others, how we transport ourselves, a variety of things that today, we haven't seen truly disrupted in the last 20, 30 years. So there's been a, seismic shift happening underneath their feet. And we can go into a little further because I don't want to, dominate the airwaves, but there's certainly things that, especially around energy storage, transportation, finance, personal finance, as well as payments, things that you might have heard of, blockchain, you might have heard of, all the incredible things that Tesla is doing, e-commerce, work from home, all these sort of life trends that are happening. In times of crisis, innovation and adoption accelerates. So I think that's the framework in which I'm looking at investing for the next 5, 10 years. I don't care what happens today. I don't care what happens tomorrow. I care about the next 5, 10 years. That's my horizon. So I'll kind of leave that there for food for thought.
Awesome. Thank you, Ken. Would anyone else like to share? All right. Let's see. Do we have any ideas from the real estate people in the room? All right. That means Eugene.
Maybe Sam, let me jump in actually.
Sure.
Well, I was just going to say, we've talked about some concepts already. maybe there's some questions or thoughts or conjectures people have, right? Are there any kind of burning questions or thoughts that you wanted to validate? Because part of the second personal investing strategies meeting was to kind of bridge between where we talked about a lot of broad kind of concepts and then focusing them into personal investing strategies. So I'm just curious, maybe from the room, in terms of your, like, what's on your radar? Like, what are you excited about? Or are there hypotheses you want to validate with a broad audience and just kind of get some perspectives on? So maybe that's an angle we can approach.
Yeah, this is Jerome here. So yeah, one of the two keywords that I heard from Chinmay and Yang was, risk. I think that's a big thing for me, is how do you handle risk, to hold onto your conviction, like where, it's not painful if the investment drops. Like, how do you hold on to that? So how would you manage risk when you invest in equities or stocks? What percentage of your entire portfolio, or a percent drop? How do you, or do you just hold on to it? Hold on to a stock. How would you manage that without having emotions? I guess, having a plan and sticking to your plan without having emotions kick in.
I think that's a great point. And for me personally, I've been investing in stocks for about 15 years, and the way I do it is I've just been following the model of fundamental value and growth investing, which is basically that identify a company that has great fundamentals. It has fantastic opportunity. It's well positioned. The management is good, and the opportunity is going to be there for many years or even decades to come. Like Ken said, you want to be on the right side of history, so to speak. So I think that it's really easy to get caught up in the noise and all the gloom and doom articles and so on. But if you want to really make a extremely successful investment, you have to be willing to take risk where other people think that it's unreasonable, but you identify that it's actually a fantastic opportunity because of your analysis. And I think the depth of your analysis helps inform your ability to stay with that conviction. And so for example, if in this current equities market, I personally saw that everything was going down across the board around March and April, right? And there's a lot of companies that were doing fine and they're gonna do great in the future, but they were unfairly punished with the broader market. So that to me meant that they were being discounted at a unfairly. So that's why I bought a lot in March. And I plan to hold on to it until basically something fundamental shifts. Like unless something like, their CFO is getting investigated for fraud or something, that's a sign that you got to exit immediately. But absent some sort of fundamental shift, I think that it's better to be prudent, and if it dips even more, that may represent another buying opportunity for you to lower your cost basis.
Yeah, and Jerome, if I could add one thing, the way you're looking at risk is a very, I think, prescient thing, because there's conventional wisdom that risk management is an element of portfolio theory. I mean, so essentially, the idea that diversification across different assets will allow you to not just manage your downside, but rely on, you can rely on a certain percentage of growth to grow your portfolio over time, over a long enough horizon. The opposite of that, and this may not be, so like that fundamental portfolio theory, diversification and risk management is, of the like school of thought that they would teach you in business school, or they might teach you in, like, if you were to read that, like The Intelligent Investor, Ben Graham, or you might read a book by Charlie Munger, and Warren Buffett. Value investing fundamentally is about looking at future cash flows, a growth of and discounting that value into present value, and then determining if there's a mismatch between what the market values something in terms of the share price and what you think the actual value of the companies today. The opposite of that is actually, in my view, growth investing. And growth investing is a combination of qualitative and quantitative. It's triangulation of the two, right? So without going too deeply into it, because I'm sure people may have different levels of understanding of all these concepts, but fundamentally, what you're looking at, instead of just looking at like the present values of future cash flows, to say, a great example is Tesla, right? And I bring this up all the time because it's the most I think the most
Polarizing.
I don't know. Yeah, it's polarizing as hell,
Very polarizing.
as you know. A lot of people talk about it. But here's the thing. The valuation of Tesla, if you look at pure cash flows today, you would believe what like JP Morgan, the analyst for JP Morgan, or Piper Jaffray believes, which is that it's worth $900 a share. The issue with that is that it does not take into account dislocations and disruption, essentially, which comes down to execution. How can you value execution? And we've seen Elon Musk over the last maybe 2 years kind of exceed expectations in terms of execution. Prior to that, 2011 to maybe 2018, 2017, we saw the share price kind of hover between like, $200 and $300 a share, like up and down a little bit, but depending. So there's no way you can justify today's share price of Tesla based purely on fundamentals alone. I always kind of say, and like I've been through 3 cycles at this point. I kind of, the value of the share price is actually a view into the future value of Tesla, not to discounted cash flow of future cash flows to today. Does that kind of make sense? Actually, when you take into account platform dynamics and they call it network effects and dislocations and the sucking of value that technology tends to display, it's a much more different argument. So I'm throwing a lot of concepts out there. We can dive a little into some things further, but that's just kind of the idea I'm trying to convey here.
No, that's definitely good. As I'm starting out, I'm been more of a technical analysis kind of type. I know that fundamentals is very important. So I just wanted to see what kind of fundamentals you guys are looking at. So it's very good that you've mentioned those. So thank you.
For me, I think going back to like the idea of risk, I kind of see the world in 2 ways, right? One is there's like market fluctuations, and that's a risk, but I actually see that as opportunity. And then there's another one where it's company performance and company trends. So in times when like the entire market is just reacting to something, whether it's I guess like negatively, then that becomes, I think of it as an opportunity to get in more into companies that I believe in. If I start to see companies where they continue to slip like 2 or more quarters, like even after 1 quarter, I might be okay. Like, hey, maybe the market's overreacting to an earnings release, right? They like, for example, for Intel, and I work at Intel recently, they were hammered because of that announcement. And I'm like, well, maybe they're overreacting. I'm pretty sure they are. I still believe in Intel. Like long term, I feel like we'll be able to get out of it. And so like, obviously I didn't invest into it just because, I already work there. So I don't want to be more tied in, but it's things like that where like one news comes out and then the whole market just jumps off the ship and you're like, oh, well, maybe there's some opportunities there. But if a company just quarter after quarter, after 2 or more quarters say, hey, we're lagging or we're not meeting expectations, then you gotta, well, I would take that as a sign of, well, they're not executing right. Is it because of management, or is it because like the market they're targeting has shifted or is shifting, so they're not able to meet those expectations anymore? And so I love the former, which is like if the market as a whole just reacts to some external news and tanks, and you see that as, well, everything's red, right, across your, your brokerage account. You're like, great. I mean, this is time to get in a little bit more. But if the entire market is, trending upwards, and there's a couple of companies that's just lagging behind for several months, then I'll look into it and see, hey, if that's something that I should probably exit for whatever reason.
Yeah, this is Greg speaking. At least one thing I kind of struggle with for myself is, so all of the industries I've been in was utilities at PG&E for 3.5 years, and then basically doing power plant development. So a lot of infrastructure, a lot of hardware, like slower moving industries and other things. And what I really struggle with is the time horizon of my investments. And I prefer to kind of do and create a thesis of a longer term investment, and to be honest, not really get in the weeds of having a lot of transactional or kind of worry about having to sell all the time. I'm really like a holder or whatever it's called. Like, I have Tesla stock from when Solar City IPO'd, and it transitioned all the way through. So I was fortunate enough, but I also believed in that tenet of like Tesla and Solar City stock will go up, especially I basically got shares allocated to me. But that's just kind of like, for me, I understand the investment time horizon, at least, that I'm comfortable with, and those industries are a little bit slower moving, and I'm more aware of how that industry changes. The thing that I'm struggling with as I get more into EVs is there's so much disruption from a supply chain perspective from China and all of that, and I see that. It really, like, as I get more and more aware of what's going on in the industry, it's harder for me to find American companies, and I work at one, to invest in and not like feel like I have some understanding of how that supply chain can be disrupted so quickly. But then when it comes to things like software or other types of industries where I have no background, I have no idea, or I struggle with like, how quickly can the rug be pulled out from underneath me? Does that make any sense? And like, there's a fundamental market shift. And I ask maybe the group of like how you guys kind of invest in areas you're not as familiar with, and understand like when you're seeing some of those trends change, you're like, oh man, this is it's a shift. Amazon is going down because blank company from China is disrupting them, and that's going to happen in this time horizon. I don't know if that makes any sense, but that's what I fundamentally prevents me from investing in some things I'm not as familiar in, and taking on that level of risk.
Yeah. Actually, Greg, you're bringing up a really good point, because I think the concept that of conviction, actually, I think the underlying concept there is that you have an edge, you have a knowledge or understanding of the market that others may not see right away. I think Sam kind of mentioned this a little earlier too. And whether it's a sector that you anecdotally have some experience or knowledge, or you just have understandings of supply chain or market dynamics that are shifting underneath the industry's feet, like this kind of foresight, not everyone can see right away. So I think Warren Buffett actually said that he only invests in things he understands. That's how he's been successful. He invested in Coca-Cola. He invested in finance, basically banks. He's recently gotten into Amazon relatively recently, but he doesn't touch any other technology stocks. So maybe some people criticize him and say, hey, look, maybe he just missed the boat or is using his edge. But I think the thing that is wise here is that I will never ever, like, for example, I've spent a number of years studying technology, in particular, up and down the infrastructure and software stack, and also the evolutions of it over time, and how companies are using technology and how it can change things. I would never ever deign to invest in, mining companies. I wouldn't understand it. Oil companies, like Greek to me, right? I would never think about doing that. I just know that there's certain behaviors that I know I can anticipate in technology, and I know that the markets may be changed forever in certain ways. If I know there's a company that's going to forever suck the value up or create new markets, then that's the winner I will invest in. But until then, until I have that kind of, again, I'm going to use the C word again, conviction, I am not going to do anything. I'm going to sit and watch. That's it. And so that's sort of like maybe a more like a framework of thinking about personal investing. Because the great thing about investing is that you don't have to swing at every pitch. You can sit and watch until you see something you really like, right? So just some quick thoughts there.
I guess I struggle with that a little bit because at least my comfort and knowledge base is in more, I'd call it slower moving and lower multiple investment opportunities. And I'm just wondering, am I, you know what I mean, missing out on some of these higher, I mean, maybe they are riskier, if that makes any sense. I mean, they're inherently riskier because I don't know as much, but these other opportunities that offer greater returns or valuations is all.
I think you guys all made some really good points. And what I want to add to that is, Ken mentioned that he studied tech up and down and became really familiar with that industry, and also echoed Warren Buffett's sentiments that he doesn't invest in things that he doesn't understand. I think it's possible to gain a greater understanding by just really studying, picking a certain industry that you're interested in, and really studying it by reading all the analysis and so on, to a level where you can gain some level of comfort. If it's still too much for you, then it's not really a time wasted. You just know that you're not going to invest in that sector in the future because it's too risky for you, or it's too difficult to understand. And in this way, you can kind of narrow down the types of industries that you want to invest in, and then really, once you identify certain companies that have fundamental differences and like they have a strong economic moat, like something you mentioned, Greg, was that you don't know, if a competitor comes along, can they erode this market share by coming up with a snazzy product or something? So I think if a company has a strong enough economic moat around them, such that it would be very difficult to peel away that market share, then that's the type of company that you can just have faith in and keep through the cycles.
Yeah. One more thing that you mentioned is like, you said like you do smaller sums of money. So like the way to kind of step up from there, if you want to look at like higher growth opportunities, is like, you basically want to see like, how much you're willing to lose, and think of it in this way, like, if I lose like, $10, am I willing to lose like, say $100 today to make 1,000 tomorrow? Is that something I can stomach? And a lot of times, like, that experience helps you learn whether you want to, like, or how that works out for you, how much risk you want to take. Because risk is like, what I've learned with experience is like, it's one of the most like overused words in finance, yet like least understood. People try to put a definition around it in terms of numbers and models and things like that. All of that is valid, but like when you're trying to go into an investment, I agree with like what Sam and Ken said, like, don't invest in something that does not make sense to you, because you lose out. Like, and this is again personal experience. Like, I've tried to put money in biotech, I've tried to put money in good biotech companies like Gilead, for example, and I just did not know when to stop, or I just did not know when to, like, when to put in, when to get out. They are still good companies, but I don't understand how they work. I don't understand how the industry works. So I did not make money in it. I tried to do oil. Exxon was a strong company. Like, I think it was the biggest company by market cap for a while. And I didn't know when to get out. So like, I lost some money on it, not significant, but you want to stick to industries that you completely understand. And this is how you get like a sense for like the risk you're taking when you go into it. You start with like, if you're trying to look at a newer sector, say someone said like, they understand EV industry or Tesla and NEO, those kind of companies better because they are in that industry and they understand the supply chain around it, but they don't know technology. You want to, like, you just have to spend time studying technology, trying to learn those associations. And I don't mean like learn software or things like that. Start with something that's stable, say Microsoft, or like, AAA company, Amazon, Google. Try to see how they make money. Try to see what mistakes they've made. Like, I think those are easier companies to put money in because even when the market goes down, like your investment is fairly safe. They're not going to like go down, stay down for long. But take lessons, like see what they're doing right, see why others are not able to come up to their level, and then start like stepping up like your risk. Like that's how you build conviction. Like why do you want to put money in Google? Like just because it's big, just because everybody knows the name? No, what are they building? Like where are they building things around the world? Where are they investing? Now which other companies stand to gain from them? For example, gain from that, e-commerce will gain from like for example, Google and Facebook building underseas internet cables around like Africa, for example. So who are the benefactors? Over time, as you learn what they do and observe what's happening with other smaller companies that you think are immensely risky, you'll see how they perform and like you'll get your own gauge for risk. And that's generally how you get into a new industry. But I would recommend against like investing in anything that you do not understand. Like conviction means you have a fair amount, like you have a why, a reason why you want to put money on them.
Hey, Jerome, a quick question on that. You mentioned a couple of times, like, hey, are you willing to invest in something that you may lose money in now, but then you might gain a lot more in the future? Are you talking about investments where like maybe the company is just not very established, or like the market is not established yet, but you feel like, hey, in a couple of years, it's in this kind of, like kind of like this turbo spooling space, right? Where it's just, don't know how long it's going to take for it to really ramp up, but you feel like it will.
Yeah, and like over the years, my understanding and tolerance for risk has gone up. What that doesn't mean is like, it doesn't mean that I have like, just started making crazier bets. It means that like I have learned to like, figure out like, okay, this is something I believe in. These are my whys. And this is how much I'm willing to risk losing. When you say risk, you can lose that. So this is how much like, I'm willing to lose because I really think that this will come out. If I put money in Microsoft, I don't expect to lose it. Like, I expect to like make some returns, but not crazy returns. But if I say like, I believe that in a few years, like a hydrogen fuel cell will become as relevant as EV, electric cars or electric battery operated machinery, this is a risk that I'm taking because a lot of respected people do not believe in it. Elon Musk lashes out against it, even though I believe in him and Tesla and everything. But I do believe that like there are certain areas where hydrogen fuel cells can work better. Heavy machinery trucks where you need to swap fuel cells quicker. You can't wait for like, charging your truck for 3 hours in a parking lot if it's a cargo truck or something like that. See why, for example, like those industries haven't succeeded over the last couple of decades that they've existed. Clean hydrogen wasn't a thing. It was hard and expensive to manufacture. So we are making progress there. So all those, like these are just few examples of why I think like that industry will become bigger than it is today. Is it a risk? It's a bigger risk than putting money in Google and Facebook, which I think will like, keep going up in the long term. But I feel like this industry will go up more than say like the safer Google, Facebook, Microsoft. It's a bigger risk. Like how much am I willing to lose if I'm wrong? So limit your downside. That's a risk you're agreeing to take, and then stand by it unless there's a reason you want to change your mind. Like Sam said, like, if they're committing fraud, if they're like, if something like that comes out, then like look into it. I think, which one was it? Like Enphase is a company that makes solar inverters and like they capitalize on selling solar inverters. or I forget what exact device it's called. So they were accused a month or so ago of committing fraud or like forging the numbers or something, and the stock fell like 20%. A lot of people got out, and the numbers that I like, whatever they sold, whatever they were building, I believed in their product. Like what they have, if you look at their people who install the stuff, customer reviews of this stuff, service men like who put these like companies that actually go somewhere and install these things, they're actually happy with the product. They say this is a very good product. So like some of those things led me to hold on to it. And now I think like it just hit like its all-time high a couple of days ago or something. So that's how you slowly learn to like take small risks. You learn from it and you grow from it. It's not like but if you don't want to put all your retirement money on it and you lose it all in a day. If you take calculated risk, if you decide like if you figure out what your maximum downside is, that's how I look at risk. If I say, okay, I'm willing to lose $100 on this if I'm wrong, because I might make $1,000 5 years from now, do I want to lose $1,000 or do I want to lose $100? That's how I look at it. And depending on the investment, like you go from like $100 to like, do I want to lose $1,000 or make $10,000, or do I want to lose like 10,000 or make 100,000? Like that's how you grow as you experience it. But like you cannot just like overnight learn what risk is by if you don't participate in the game. Does that make sense?
Yeah, absolutely. Thank you.
But conviction is like you need to have a why you believe, why you have that conviction. Like it's not just like my friends told me that this is a great industry. I've been reading it in the newspaper. I've been reading it on the internet. Like it must be great. That's my conviction. No, like you have to have a why for it, which is another reason why like you don't want to invest in something you don't understand.
Yeah, FOMO investing is I think a big issue right now, because I think investing has certainly been democratized by like a lot of new pathways to investing, such as Robinhood and Webull and what's called stock or something like that. So I think that's contributed to a lot more fickleness in investing. But I think one thing I want to bring up also, aside from like how to build conviction, which should always change, should evolve over time. I've changed my conviction in certain stocks over time simply because I saw that execution was not being, not sufficient. A great example is Box, which I looked at in 2012, 2013. It was a kind of a hot stock, and people saw a lot of potential because there was a lot of interest in their ability to translate the data that they're collecting into some very significant AI potential products and features. That never came to fruition, and so my conviction on that stock changed. But I think that the greater thing, I think, maybe for more earlier stage investors to think about also is macroeconomic trends. And maybe I'd like to get people's perspectives on that a little bit, because I've been observing markets of capital, flows of capital, and sort of the rise and fall of certain industries and certain companies over a 20-year period. And I think the macroeconomic condition we are in today is without a doubt a unique situation. There's probably not a lot of precedent for this. And I think the behavior that we're seeing right now, for example, Sam said he bought it, a low in March in certain industries. I think that kind of confidence also comes from the very fact that we've seen what happened in 2008, when the federal government printed a lot of money to save some certain industries. We're seeing that again now, and it's happening faster than it happened in 2008, in fact. But we're also seeing a very low interest rate environment. So there's all kinds of macroeconomic trends and exogenous factors that are contributing to this kind of environment. I'm curious what everyone thinks. I guess maybe your observations. What are the red flags or risk factors that you're looking at right now, and how that affects your investment strategy? Maybe I can pose that as a question.
Yeah, I think that's a good one because I also feel like with this change in market dynamics, there's like so much opportunity, right? Like the market and behaviors are shifting, how we buy things, how we live. But then to your earlier point, right? Also the the fact that investors it's so much easier for them to get into the market and invest, and all this FOMO money going into the market, like going into stocks where I think, okay, well, actually that stock I feel like has a bright future given how things have changed in the last 6 months. But at the same time, it's like if you look at the charts too, it just straight up, right? So you kind of think to yourself, like, how much of that is just the FOMO here? Like maybe 3-4 years down the line, it's still you're going to be making money off of it, but is this really the time for you that you would want to get in? I think to me that's a risk. I don't know how to address it.
Yeah, for me, that's like, I have some capital I want to deploy. And the biggest thing for me is I'm at least concerned is, are the industries that, well, especially in EV, like there is money because everyone sees that macro trend and they see it as a less risky, longer term hold. So they're just putting money in it. But does that mean it's like honestly overvalued? And is that happening in other places? And is the bottom going to fall? Is that going to drop 20 or 30% in a year or two because everyone realizes, oh, you know what I mean? Like everyone just put money in it because they had to invest in something, and there's more access and there's just capital that they're diverting from other markets that they clearly see as very risky, like airlines or something. I don't know if that's the right way to, but that's some of the fear I have, at least.
Yeah. Well, I'll give you a framework of how I'm thinking about it right now, and maybe you guys can help me validate this maybe. So I think there are kind of 3 primary factors happening right now. So I think obviously number 1, very low interest rate environment, which was a factor even before COVID, which meant that there were, let's just say, credit is easy. That money needs to go somewhere. And you saw that happening in the venture capital market, where you had these mega funds like SoftBank, and just like seed funds that were traditionally generally the $3 to $5 million to $10 million range, and now they're super seed funds that become 20, 30, 100, $150 million. So that's number 1. Number 2, we've got just essentially this inflationary environment, right? Which obviously is connected to low interest rates, but with the way a lot of the governments in the world are handling COVID, they're printing money because it's essentially the only way they can handle and control, or at least get a handle on demand. Essentially, there needs to be continued spending. What does that result in? Well, people are looking at the CPI and saying, well, the inflation is going at a certain rate. The value of currencies are obviously going the opposite direction. And then you've got basically this situation where assets have to go up because there's nowhere else to get the alpha. So, there's this flow into equities in particular, but it's happening in other assets too, such as cryptocurrencies and also commodities, such as gold. We saw a big gold run up in this month. And so, the capital flows are also going in that direction as well. There was one other factor I had to tip my tongue, but I forgot. But my framework of thinking is this: the environment that we're in is unique, but I don't think it will go away. And so that tectonic shift in investment attitude. The last thing I was thinking about was demographic trends. So this is again relating back to capital flows. The baby boomer generation in particular, at least in the United States, have a very particular investing behavior compared to, say, millennials, which is the next big bulge in demographics. And so their investment behavior, they tend to be a little more conservative than millennials, and we're seeing the effects of millennials on the equities markets. But they certainly are, I think their investing behavior is influencing certain stocks being priced and valued by market cap much higher than others. And then once they start retiring, or once, and they're starting to at this point, this decade, we're going to see this huge influx of retirees. Maybe they're going to cash in their 401k. Maybe they're going to sell some of their real estate holdings. Maybe they're going to invest in different assets to preserve capital in other ways, or change their spending habits. That's going to affect how the market's going to behave for the next 5 to 10 years. So my framework of thinking is this: I care about the demographics, I care about the monetary policy, and I also care about how governments are their fiscal policy is being determined. And that's not even talking about things like geopolitical risk and technology shifts, disruptions. So that's kind of my framework. I don't know if any of that kind of made sense.
I did. Ken, in terms of your thought around the capital flow, right, into the equity market because there's nowhere else to go, so it feels like that's a risk, right? Like an opportunity and a risk if you can write it. But at some point, there's going to be another investment vehicle that they can move that money into, right? So at which point do you think that mountain may collapse?
Yeah, I don't know. I think equities are the most fluid. Other equities and markets, and these are the most liquid markets out there. So, I don't know if there's going to be an alternate market necessarily that would say take the place of equities as it stands today, and the top 0.5% of stocks that are seeing the most outsized gains. I think there's a seeking of alpha happening right now that we haven't seen before because of just the sheer size of the demography. But how that shifts, I won't be able to make a conjecture on. What I would say, however, though, is that there are different asset classes that go in vogue and go out of vogue. At some point, there's going to be some kind of shift. I just don't know what kind it is going to be. My bets, though, aren't going to be purely based on demography or fiscal policy, because my bets are going to be based on where value gravitated towards, right? So some people say, hey, like my sister, for example, is like, hey, you should invest in MongoDB. And I'm like, oh, great. I know about MongoDB. I know a lot of companies are using it, and I've seen the stock go up. But why? My philosophy is why would I even why would I want to invest in tier 2 players when I know there are certain companies that are going to be just these leviathans that are going to just totally kill or change several industries at once, and we know who they are, right? So that's I only want to invest in winners. That's it. The number one. I don't want to invest in number 2, number 3. For example, people are investing in Tesla and they're saying, hey, I missed the Tesla train. I'm going to invest in NIO. I'm going to invest in Nikola. I'm going to invest in Workhorse. I don't want to do any of that. It's either I invest in Amazon, Google, Facebook, or a few other players, or not. And if any of the execution of those companies or the regulatory environment changes for any of those companies, I'm going out. There's no other alternative for me, because I think that that's where the outsized gains will be. Otherwise, there's no point. Right? You're just basically going to get 5% above the S&P 500 or something like that. That's just not valuable allocation of capital for me. Does that kind of make sense?
Yep.
I agree, Ken. I think it's not wise to chase the next winner. you gotta find where you're gonna get the best gains and go there rather than just seek some place to put your money. And in that sense, it is very helpful to be patient and just wait for your opportunity.
Yeah, it's also opportunity cost. If you invest in NEO, you're putting also capital at risk, right? Not to say that NEO won't eventually be some sort of winner. It could be because it's the biggest player in China, for example. Like I saw a lot of people get burnt when Nikola went up to 80 and then what's it now, 36? And that's because that was FOMO investing. They were going, hey, these guys also make EVs. And then if you dug a little deeper, you realize, Trevor Milton sold like 70,000 shares of stock at $10 a share to buy a mansion in Utah. Or that their Badger truck essentially is like AutoCAD-like design. And the thing they showed at the last trade show was essentially, wasn't even a functioning like a hydrogen fuel cell truck. So, this is the kind of thing that if you have the conviction and you do your research and you are studying as you invest, these facts will emerge, right? Execution matters.
Absolutely.
Yeah. Hey, I had a real estate question. Gene, you're on. You've been pretty quiet. Sam, you're on too. So, a question for you guys. So here's my situation, right? I've been looking at homes in the Bay Area, and with the COVID, I guess not just myself, but like even the broader audience, they're just kind of moving out and shifting, kind of flattening that kind of. I think of this as like a mountain of money, right? Like in the Palo Alto, Cupertino area, and now people are moving that money into areas like in the spillover areas. Is that something that you guys are seeing too? And what do you think that it translates into like 6 months from now or a year from now? Is that going to continue, or is that just a near-term thing?
Are you saying that you think that the people are moving elsewhere?
It feels like the spillover areas are getting a lot more expensive. Like the markets there are really hot in places like the Tri-Valley or like, in the outskirts of San Jose, like in South San Jose, places that would traditionally be a very long commute for people, but they would have decent schools and big houses, those areas.
I think it's difficult to speculate, but there's a conversation in the real estate community, both residential and commercial, that these trends could be sticking. Because people suddenly realize, the former hot trend was co-living. Like you split up a former apartment building that and into much smaller slices, so you can charge much more rent per square foot. But now with the pandemic and people realizing like, hey, I'm stuck here living in a tiny space and I'm paying a ton of money to live in San Francisco, so they're moving out, and all those developments and strategies are going belly up. I think there could be a spillover effect, like you mentioned, but it's really difficult to predict the size and amount of it across the country and across the Bay. My feeling is that the Bay will retain its value because, like New York, it's a nexus for job growth. There's a lot of innovation happening there. It's not going to stop over time. It's a matter of when it gets back into it. But I think that these hot areas, these hot metropolitan areas, whether it's the Bay or New York, they're going to continue to grow over time. Whether or not that happens in the next 6 months is really tough to call.
Yeah,
I agree.
Go
I
ahead,
agree with
Jane.
Sam. I like his his points are good. I think the price is not going to drop. Well, I mean, like it's okay, relatively speaking. And also I think the reason why even the outskirts areas are getting hotter, because everything's getting hotter right now. Everybody have cheap money. Everybody trying to buy something. So that's why it's hot. So whether it stays this way for long, I don't know. Yeah, that's how I see it. I understand, like even the outskirt area are getting even hotter now. It's insane.
Yeah, the thing is, I haven't paid attention to like the like the more wealthy areas, like Mountain View, Sunnyvale, the peninsula, and all those areas. I've been more focused on the outskirts, and it just feels like the outskirts are just insane. It's just blowing up. So I don't know if you've seen something similar in the other areas where I'm assuming people are shifting out of, or if this is just happening in those areas as well, and it's just an overall an overall increase in prices across the board.
Yeah, I think it's more of overall increase of price across the board, like in more expensive areas too. Yeah.
I think commercial real estate is a place to watch. It's very interesting what's going on there, because and that will definitely affect the stocks too, as it spills over, because there's a lot of shifts. Like, for example, are all these tech companies going to continue to lease up all that like prime space? My gut feeling is yes, after seeing the reports and the conversations with the various investor groups. But like it's been tough to collect rents from many of the tenants. A lot of small businesses are going to go out of business, and that's a lot for retail. Like, there's going to be an accelerated shift towards doing transactions online and just finding out solutions so that people don't actually have to go physically when there's an opportunity to do so. So I think that the pandemic highlighted weaknesses in the system that were already existing, and it's going to exacerbate and accelerate that kind of trend over time, because the way it looks like the pandemic isn't going to just go away very quickly, and things won't just go back to normal. Rent collections across the country have been pretty muted, and depending on the sector, multifamily is obviously the best. Retail and hotels are suffering the most, and in office, it really depends on your location. But industrial has been performing. Industrial, the businesses still need to do their data centers. They still need, all the tech companies need their data centers, and all the warehouses and stuff are still working. So, it's had a really interesting impact across the spectrum. And I think that strong metropolitan areas like the East Coast, Pacific Northwest, some parts of the, like, say, Texas area, and SoCal and Southern California and Northern California, those will remain strong. For tertiary markets, it's harder to say. Like, if you're a Class C operator of a retail place, it's looking pretty bleak.
What usually happens to those places, right? Like, as small businesses go out of business, and you have these half-empty strip malls, what typically happens to them?
They're screwed. They're gonna have to give the lender back the property. The investors lose everything that they haven't already gotten, and the operators are now out of business. We've seen that happen a lot, actually, because I get reports from all over the country on what happens to these tenants, because we have portfolios of properties all over the country, hundreds of properties in each portfolio. So we see, individually what happens to these tenants. If the operators are unable to collect enough rent, usually they have been pretty prudent about cash management, and they have saved up for like a rainy day. But no one predicted, 0 or 25% of revenue for like half a year. That's really hard to sustain, no matter how conservative you are. So a lot of these operators are going to suffer unless they are well positioned, like their overall company. So, with these single tenant places, or these operators in tertiary markets with a lot of their tenants not paying rent, that goes to our multifamily too. Like, if you're in an area and the tenants start wising up to the fact that you can't pay off. Landlords can't enforce an eviction until like probably next year. So theoretically, if you're a bad actor, you could just not pay rent until sometime next year. And then the landlord will be stuck with all that mortgage, principal, interest, and all that stuff. So, you know, it's very hard for the owners to hold on. And so a lot of these cases are going back to the lender. If you're strong enough as an operator, you can hold on, but otherwise the collapse of the small businesses will also lead to the collapse of a lot of landlords and real estate owners. So it depends on where
Yeah,
Sorry, go
Sam, you brought up an interesting thing actually, because I think we're starting to see, I think the rule in New York City now is that the eviction freeze is going to be, I guess, relaxed in a couple, like maybe this month. I might be wrong there, but it's certainly soon. I read that somewhere.
Interesting.
A lot of people talk about the strength of the markets in the metropolitan urban areas, and I hear that a lot, but I'm just kind of curious. I mean, what is the downside scenario? Let's just say things don't go well at all, and the relative strength that we've seen in residential, so the weakness in commercial translates into bleeds over into residential. Is there a scenario where we start seeing real estate prices collapse in any way?
I think so. I think that's a definite valid scenario. It really depends on the shifts. Like, if your thesis is that there's a long-term shift in the way that companies do business and businesses operate, in terms of like, do we need this prime office location for people to work? You know, if your view is that the pandemic has forced everyone to reevaluate that and say like, hey, I don't actually need to lease up all this space, then you could see empty offices, and that could lead to a cascading effect where people are like, why do I need to live in like a tiny apartment in San Francisco when I can have like a 3-bed, 2-bath of like 3,000 square feet and, you know, much farther away? I can just work from home. You know, that could cause a seismic shift in residential prices and offices. But you could also take the opposing argument that, you know, large transactions and large business is done face to face. And that's been the case for, you know, as long as human history has occurred. And we've had good technology in the past. You know, you could have argued back in the day, like when phones first came around, like this is going to change everything and people aren't going to face each other anymore. And to an extent, it has changed everything because we can work from anywhere in the world and talk to each other. But that face-to-face interaction is also a really compelling reason to do interactions. Like, are you really going to close a multi-million-dollar deal without meeting face-to-face? It seems unlikely. But, you know, I think there are compelling arguments for both sides. I'm personally of the belief that there will be more shifts to online business and more virtual work, but it won't cause such a seismic shift that people will flood out of, like, say, New York and San Francisco areas. I think those areas.
But then play that out a little bit.
Sure.
Yeah, it makes total sense, Sam. But let's play that out a little bit, right? So, assuming that commercial real estate, you know, we start seeing a lot of softness there. Does that mean that creates a supply? Like, let's just say, you know, residential real estate stays somewhat the same. I mean, that could be debatable too, because as people may move outside the city. For example, New York City has a lot of suburbs around it with pretty good public transportation. You could move out the city, or you could simply just live in your apartment and work from home. There's no reason now, though, to be in the center of Manhattan, though, except for maybe 1-2 meetings a year where they're super important, right? That kind of thing.
Right.
So let's just say if we play out the scenario, commercial real estate that becomes oversupply. Does that mean at some point they turn them into residential, and then you get more supply of residential real estate? Like, what's the potential scenario down the road if things don't go as quickly to recovery in the metropolitan areas.
I like that idea. Actually, I've talked to other agents too. I'm just speculating something like that will happen because there's going to be a huge amount of supply for office and retail and whatever. There's already is from what I see. There's already is a lot of supply out there. They're going to change it. They're going to relax their development rules, allow other changes like a mixed use, or maybe even like a loft work kind of situation. I think I see that kind of thing going to happen next like 5-10 years in the Bay Area. So keep your see, like for example, like just say 4 years ago, there's no such thing as JADU or SADU, and even though some city has it, like parking requirements are like crazy. But now in 2020, it's exact opposite, and this is like a opportunity for all the real estate owners out there to just bank on it. This may not last that long. Maybe one day, it will, not maybe, it will have like a supply, too much supply. It's always fluctuating. There may be one day that there's too much supply, then the government will say, you know what, too much ADU, we're going to stop it. I have a feeling, I think it's going to happen. So if you want to, have a crystal ball, that's going to happen one day. So just bank on it, man. Forget all the COVID crap. That's just noise, really.
I think that's a good point, Gene and Ken. Like, there's going to be a lot of weakness for sure in retail because a lot of those are going belly up, and so those are going to be empty. It's really hard to release. Like the cycle to release a property generally takes several months, even if you're really fast and you have like demand. And then there's going to be a disconnect between what the owner wants to lease it at and what tenants are willing to, because from the tenant's standpoint, there's a bunch of supply now. There's going to be a bunch of supply as these other retailers still go belly up. And so when that happens, the tenants are like, why do we need to pay so much? And so I think unlike stocks, where everything's very liquid and the markets are much more efficient, real estate presents an opportunity to capture some of those inefficiencies while you don't necessarily have a connection between the buying and selling price points. Like there needs to be an adjustment, and until that happens, like there are lots of inefficiencies that people can capture. In terms of will things go to residential? I think because real estate is always a measure of what's the highest and best use for this property, and that may be retail, that may be multifamily. If it's retail, like you calculate things on sales per square foot. Like if you're a retailer, how much can I sell per square foot that I lease? And if you're multifamily, you want to see how much you can slice up that property and rent out to people. So I think it's really a calculation of what people are looking for, and if there isn't that much demand for retail as these national retailers go bankrupt, then we could see a shift towards residential being built on top of retail as they get rezoned, as Gene mentioned. Because there's lots of restrictive zoning requirements. It takes a long time to get your project entitled and permitted and all that stuff. But if cities are desperate for revenue, or they see that like there's potential blight occurring in like the large metropolitan areas, they're going to take steps to combat that.
I mean, you see that in local cities like Milpitas, right? Like how they all of a sudden the mayor said, you know what, we're going to build 60,000 new units, and that's what happened. Just start tearing down all these warehouses, and man, it's insane. Everybody went like, they say 5 stories, but some are extremely high. They're podiums and they're super high, and it's completely changed the environment. So it could happen when push comes to shove. It's just one signature away from all that change from the mayor.
For those who aren't familiar with the area, Milpitas is right next to San Jose. And for a long time, like much of the Bay Area, it was anti-growth, like anti-development. A new mayor came in, riding on political waves that, like, hey, we need more affordable housing, let's develop. So the mayor approved and fast-tracked a lot of developments, and now there are a lot of developments in the area. It's not like the high-rises you're used to seeing in New York and so on, but it's kind of startling for the Bay Area. And keep in mind that Milpitas is, very close to San Jose, which is close to a lot of the tech companies in San Jose, Mountain View, Sunnyvale, and so on.
What's also interesting though, Sam, is that you see a lot of, and I don't know if this is the case in San Francisco, but you see a lot of retail spaces that have remained tenantless for the longest time. Like in my neighborhood in particular, it's a fairly developed neighborhood, I suppose. You see retail spaces that on the main drag, essentially, that simply haven't had a tenant. And the theory is that the landlords are collecting, I guess they're writing them off, or there's some sort of tax break that they're taking. So they're under no duress to take on tenants. Does that equation change too? Like now that there's a lot less competition for these spaces?
I think so, because it depends on, the landlord, how much, like you said, how much duress they're actually under. If their other tenants start failing, then they're really going to be motivated to fill those up, because there's only so much operating loss that you can take before it doesn't make sense anymore. You want to make sure you have to meet certain covenants with your lender too. So the lender isn't gonna like seeing a lot of vacancies and loss of income in your property, and they have tools to enforce things like that. Like they may escalate certain items, or they may require larger deposits or things like that. So the lender isn't going to just sit by while your property sits like vacant. So I think it really depends on the makeup of the property, like how much net operating income is actually being produced from the property, and from there, like each investor or each landlord will make their own judgments. But in general, we don't like to operate at 100% occupancy if the property is large enough. Because theoretically, if you are operating at 100% occupancy, that means that your price point is low enough that you attract enough for 100% occupancy. What you actually want, and what's called a stabilization, is in the low 90s, like say 91 to 95%. That's called a stabilized property with strong operating income, but with the leeway to adjust rents to market price, which should be growing higher as time goes on. So that could be one reason why they're letting some spaces sit empty. Other reasons could be that their price expectations are out of reality, or they're just not able to lease that space. I don't know what the situation is, but those are all situations that are pretty common.
Well, are we talking about retail space leasing?
Well, this example is retail, yeah.
Yeah, so like I did retail for the longest time. I had at one point 11 retail center listings, and it just depends on motivation. Even without COVID, right? It depends on the motivation of the owner. And some owners, man, like they just don't care. They have a lot of money there. They just don't care. Actually, most owners are like that. Actually, believe it or not, they don't care about vacancies that much. Well, and they're very stubborn on their price. But with COVID and with all the retail going out of business, it's getting really, really hard. I mean, there's only so many boba teas you can like have in one shopping center. Like I seriously would say like more than 85% of the callers calling are like boba teas, right? And I'm tired of that. So there's just so many things you can do in the shopping center. I don't know what they're going to do, honestly. There's definitely a price compression for rent, and I see that. And I'm still leasing like 4,000 square feet retail if anybody wants to rent. But seriously, I don't see it. I don't see the light at the end of the tunnel at all. Sometimes it takes years to lease. This one's been sitting there for 3 years.
Yeah.
I had 0 callers. It's not that I'm not advertising, man. It's just that undesirable. And it's a good location too, but it just takes forever. Well, now that we have one tenant right now, but we're still working on it. But anyway, I don't do much leasing anymore because it's just a lot of work, too little money, in my opinion, as an agent. But anyway, yeah, I see like retail dying, man. I don't see any. Actually, that was my main focus is retail commercial agent. Yeah, it's a lot of problem. But
Yeah.
the weirdest thing is like the price keep going up as far as the building goes. Oh, about potential problems. So there's one side, right? Family money, right? People who own it will have very, very little like loan on it. But there's another side where people are extremely aggressive, like they're all like numbers guys, right? They buy it, they like heavily leverage it. You want to see those guys die. Yeah, because what happens is if you have so much vacancy, even the lender will start calling you, the owners, like, hey, what's going on? Why are you not leasing us out? Like, we probably will not renew your when the balloon payment comes. Like, we're not going to give you a new loan, so you better hurry up and lease it out. You know, stuff like that.
Yeah.
And the turnaround rates on retail is extremely high. Like I feel really bad for leasing people out. You know, for example, like Filipino lady who just dumped 60 grand. That's all her savings, and she wanted to open a dollar store kind of thing. And in my mind, like, dude, you're gonna die. And sure enough, within a year, she called me, hey man, can you help me sell this? I'm like, I was just like, hey, I feel bad because I will take 10 grand from you if I sell it. So why don't you just list it on BizBen yourself and try to get your money back? 3 months later, he's gone. And the turnaround rates for these guys are always like at most 3 years, right? You got like doggy cleaning business, you got restaurants, you got dollar stores. I mean, these guys are just they change all the time, even without COVID. Now with COVID, how the hell are you gonna survive? The landlord with any type of loan will be dying right now. So unfortunately, that's what I'm gonna see. Yeah.
Yeah.
What's the proportion of oh, sorry, just one follow-up question on that. What's the proportion of properties that are owned by these like sort of well-capitalized families, or just people that like have fully paid off the property versus the people that are fully leveraged and having to do some financial engineering to maintain, you know, their ownership or have some cash flow over time? Like,
I think by and large,
or
from a larger standpoint in terms of like properties across the nation, most of them are owned by professional investors, at least for the investments or property size, like say 10 million and up. I don't know the market that well under 5 million, but at least for middle market transactions, you're gonna see more professional management. So most of these aren't going to be like they're going to have a good amount of leverage on it, and they're going to be operating like a professional team's going to operate it. And yeah, so they will want to lease it up, and they will have lenders that they need to answer to for middle market.
Yeah.
Can I share my point of view of that answer?
Of course.
So my point of view is because I don't have those like big portfolio guys, right? I only have actually like a couple of times I have deal with them. Yes, but then there's still, well, who I deal with, they're still like really big family, like Westlake, for example. You guys heard Westlake from the Bay Area? They own like everything, right? So they don't give a F, like I literally gave them like seven LOIs, and then the management is just so, in my opinion, those bigger companies, they're like, management sucks. Seriously, like I give them leases and they're like, oh, what do you think, Jeff? What do you think we should do? I'm like, I think those kind of tendencies not great. Let's just reject it. This seriously the conversation we have in a sales, like in a rental meeting. I'm like, to me, if I'm the owner, I'll just slap him. I'm like, dude, this is a qualified tenant and they have a lot of money. They giving good rates, and this tenant fit is, it's great. There's like nice mix. It's mismanaged. Where am I going with this? So point is, so I see a lot of old family money. Like I would say like 90% like old family money. Most of the ones I manage actually are all like that. Very rarely I see somebody who's highly leveraged, who's like a young buck in the game and try to get this going. I don't see it. There's a lot of cash owners, so those guys will be fine actually in the Bay Area. I'm talking about like maybe 10,000 to like 50,000 square feet retail spaces, like those corner lot, mom and pop kind of thing. Yeah.
Yeah, that makes sense. And actually, that's a source of deal flow for the larger professional investors. They go after the mismanaged properties specifically, and they try to get off-market transactions that way.
Call me.
Yeah. I think you had another point I wanted to add something to it, but I kind of forgot. Oh, I want to add that office is largely similar. It's quite similar to retail in that it takes a long time to lease up sometimes. What we're seeing in the market is for larger like national credit tenants, they're asking for what's called build to suit. Basically, you have a property, you're getting it entitled with the city and the county, and then you go out and prospect for large national credit tenants to take up a lease for your property. And you say like, hey, we're gonna build everything according to what you want. That's called a build to suit property. And so a company like Amazon will come in and say like, hey, we have these specific requirements, and can you meet it? And then they'll go out and like hit a lot of areas like this, and then the one with the best suitability will often win that contract. And so that's like a pretty big value add opportunity there. But the question is, can you land one of those tenants, and you have the expertise to do all of that? So that's one other interesting aspect of not only office, but industrial too. They do that for industrial.
Yeah, they do that for retail too, actually.
Oh, nice.
Yeah, like Starbucks, they do it. I'm working with U.S. Army right now. They built to suit too. They'll dump like $1 million, but then they have specific like architect, and they'll dump the money, but they want to work with the owners to build it a certain way. Extremely
Nice.
strict about that. Yeah.
U.S. Army strict.
Dude, it sounds badass. U.S. Army. But man, they're strong. They don't even ask. Okay, so how they operate? It's funny. Like how they operate is they don't write letter of intent to you. They don't write offers to you. They ask you to write offer to them. Like this is how we operate. Okay. So it's exact opposite. And they want to get into your lease before we talk about prices. I'm like, how does that work? But that's how they operate. So I'll tie you down, and then they talk about money. So
I see. So they care about the terms.
No, they do. Yeah, they do care about the terms. Yeah, they want to everything their way for sure. Yeah, because they know they have that power. They can dictate. Yeah. Interesting. No one does that, man.
Yeah. Does anyone else have something to add on that subject? I know we haven't heard from Kim or Sylvia. And the mysterious person on the phone, 646648.
That's me.
I just like to learn. So it's just kind of interested to hear like everybody talking about the retails and what's going on there. So just kind of want to hear and listen.
Awesome. Thank you. Okay. Well, we have gone an hour and 40 minutes, and I feel like we could go longer, but this is probably a good point to wrap up too. We can always continue in a later discussion. So what we like to do at the end is what's called a wants and needs session, basically just sharing what you are working on, like what you want from the other members in this group and what you can provide for other people. So why don't we go down the list and share? Let's start with Chinmay.
I step away for a moment.
Oh, sorry.
You want someone else to start, so I, pick up from there?
Sure. Okay. Let's start with Gene. We're doing wants and needs, Chinmay.
Okay.
Basically, what you would like from the group and what you can provide to the group.
Okay. Okay. Let me go.
Okay.
Sorry, Gene. Yeah. So what I'm looking for is, learning about new opportunities that I haven't had experience with. A couple that come up is one is real estate, which I'm looking to get into. I'm working on a duplex property. I'm trying to close a duplex property in Arkansas, right next to the Walmart headquarters. It's my first one. It's not too expensive, but like getting my feet wet kind of property. So learning about residential real estate from you guys. So like this last 1 hour was very helpful. Some perspective there. So I'd like to learn more about remote investing and like how you basically get into and ramp up in residential real estate. The other thing that I've been curious about is how do you get into more I think Ken said like he's into angel investing or private equity investing. That's something that I haven't even when I've done it, I've done it through syndicates or companies that basically facilitate that, like seed invest or that kind of stuff, and not really on larger scale. So I would like to understand how that works better more. What I can contribute is so I've been trading equities for a long time. I've seen I've worked with traders. I've understood their trading fraud and day trading strategies and things like that. So I don't do day trading, but I can definitely help beginners with teaching them how things work to some extent, at least on the basics, and help them get a hang of what risk means, how they should play to their strengths, what they should not do, that kind of stuff. So I can coach in those areas and share my experiences of whatever I'm learning in real estate, help them with that.
Awesome. Thank you for sharing. All right. Next we have the 646 number. Is that your number, Ken, or is that someone?
That is indeed me. I had to dial in my phone. Yeah. Okay. I can go next. No worries. I can go. Yeah. So in terms of what I would like to explore further is certainly, obviously, always looking to learn more about sectors that I don't have great familiarity with. So I think someone mentioned that there was someone who worked in sort of clean tech, EVs to a certain extent. Would love to learn more about that kind of stuff. And maybe for one of our next roundtables, we can do a deep dive in one of the sectors, right? As we develop conviction, it's important for us to, you know, learn deeply about certain kind of topical areas. So that might be an idea for one of our next roundtables. But yeah, so that, and also I'm also exploring residential real estate and dipping my toes in that. So always open to discussions on syndicates and other things like that. Where I can help is, I think, Chinmay, you mentioned angel investing, things like that. I can offer some perspectives on how to access some of the investment networks, especially in New York, and also do investment syndicates. As well, I can also help with, you know, with things I have some level of expertise in, which is certain sectors in technology, namely SaaS startups and cloud computing, other areas that I might have mentioned in the past. So happy to have any kind of those discussions.
I'll take you.
Next person. Yeah, absolutely. And you're right across the river too, so you know, not a big deal. We can definitely hang out at some point.
Right.
Yeah, nice. I see you training some kickboxing too. I'd love to train if we're closer together.
Yeah, definitely. A trip to Thailand for our next outing. How about that?
Oh man, that sounds awesome. All right. Next up we have Gene.
So we talk about conviction, right? So my conviction is not really for real estate and whatnot. It's really to help my friends and family and friends grow rich. That's actually my conviction. So whatever that means, right? So, and in my opinion, I mean, I go all out when I'm at that level. Like when I do projects, it's just like, it's not even about money anymore. Cause like I could go flip burgers and I could make more money kind of thing at some point. But anyway, so that's the conviction part. And professionally, I love do value add development / flipping, whatever, like value add residential. That's what I like to focus on, because I think it's pretty fun. I do have all the connection to do it. So like I'm still doing that. So glad to help, and love to listen to more different aspects of investing from you guys. You know, like I don't do stocks, you know, so and equity. So like it's great to listen to, you know, all different perspectives. It's enjoyable. Thank you guys.
Awesome. Thank you for sharing that, Gene. Next we have Jerome.
Hey guys, so yeah, like I said, you know, I'm like at the very early stages of my investing career. You know, I have some capital that I want to put to use. So the stock market naturally was the place to go where I can learn. Right now, I want to, you know, consistently, you know, earn 10% of my capital per month. I think that's a goal. I think it can be achievable. So I'm just, you know, looking to network, generate new ideas, you know, strategies and such, you know, and then naturally after that, I definitely want to get into real estate. I think that's, you know, the next step within 5 to 10 years. So those are my goals, you know, and I like to win. I like to have fun. So I want to, you know, kind of have fun with the people who I can grow with. So that's what I'm looking for. What can I offer? Well, right now, like I'm really learning. You know, I like to work. So, and I just like to keep my brain active. You know, I like, you know, analyzing things, you know, and so those are the things I like to do. So hopefully I progressively, you know, grow after this. So yeah, thanks guys.
Great, thanks, Jerome. Now we have Kim.
Hi there. So I don't really normally invest in a lot of stocks. So I really did appreciate the first part of the discussion with stocks. As a matter of fact, in March, I actually did drop a portion of my portfolio to actually raise capital for hopefully next year's moves in real estate to further add to my portfolio. So my real estate, the real estate is actually really my go-to. So although I invest a little bit in stocks, is usually to kind of raise a little bit of capital for the real estate. What I'm looking for is I'd like to go into, since I have multifamilies, small multifamilies already, I'm kind of done with that area, and I feel like I need to expand. So me expanding this next year would probably be going into purchasing a mobile home park, because I'm kind of tired of taking care of the actual structure now. I'd rather take care of the infrastructure. So hoping for a mobile home park. If not, as you mentioned, you know, we're kind of anticipating a softening of the market in the retail sector and in the commercial sector as well. So I'm not sure, I might divvy up the funds and can maybe go into both of those areas too, depending upon what opportunity rises, you know, this next year. So hopefully things will work out well. Well, I went over what I need. I guess was just really the investment opportunities for next year. But what I'm also looking for is just other real estate connections. So I'm always open for that.
Awesome. Happy to connect.
Yeah, thank you.
All right. And we have Sylvia.
Am I the last one?
I'll go after you.
So what I want to learn, so I just kind of want to learn the perspective of the investor. So I'm new in the commercial. I'm more into residential agents, and but I kind of have like a background in construction, so I can build house ground up. And eventually I want to be the investor myself. But at this point, I want to learn everything that I can from other investors that is being experienced or new, to get to know what they need. And then so when I finally able to get the clients, I know how to provide them the value and get them like a good investment, because they take a lot of money to invest into the commercial things. So the more I know details and aspects, the downsides and what they need and how to find like a really good property for them, I think the better that I can offer my service. And at the same time, also learning and eventually when I have enough capitals, and I can jumping in and start to build my own portfolio. So what I can offer right now is pretty much like, I'm not in the Bay Area, but if anybody's kind of looking for, you know, like to reach out into the Central Valley, either in residentials, I just learned about how to value the income property on the single residence. And if you're also looking for the multifamily, I'll definitely trying to give the best, you know, like evaluations for you, and to see whether that will be a good investment or not as we go. So that's my give and take.
Great. Thank you, Sylvia. And I'll go last. So what I can offer is, I guess, investment opportunities, connections, and I have some knowledge in equities. I have some knowledge in residential and commercial real estate. I'm happy to share that. And what I'm looking for is also deals and capital. Always looking for interesting real estate deals, as well as capital partners who would like to put their money to work. And I guess the final piece is thank you all for being a part of the AIN community. We really value you, and you know, appreciate your time on Thursday evening. It's been wonderful listening to and learning from all of you. So thank you very much for that.
Thanks, guys.
Yeah, thank you. Sylvia, can I ask you, I'm from the Central Valley area also. What city
Oh.
are you from?
I'm from Fresno.
Oh, okay. A little bit further south. I'm in Stockton.
Oh, so you stopped it.
Yeah.
I see.
I have heard Fresno's a pretty good market too. So
Fresno is really good market. When I don't know like if it's too late to share with you guys, but I just recently attended seminars, and then they show all the gloomy statistics about the futures of the commercials and everything. But one thing's for sure, what they saying is that if you able to get like the income property that is have to do, I mean, give you a steady cash flow, you shouldn't be worried. You should, you know, like keep it, as you know the market is not going to go well like in the near future. You have to let go, you know, your bigger assets that it doesn't really generate incomes or cash flow right now, and then holding cash. And when the market is not doing well, that's when you kind of start to buying back whatever that is there. So Central Valley, I think, is pretty steady market because the price is still like the cheapest compared to the Bay Area. And then I don't really think that with the lower price that we have it right now, when the market's down, that is going to be really impact that much. So and that's why I say like it's still pretty good markets. And then I think a lot of people start to looking into more and more into the Central Valley area in both residential and also multifamily, and also for the warehouse industrial, because there's still a lot of plenty space and lot that is available for them right now. So yes, I agree with you. It's pretty good market right now.
thank you.
Thank you.
Great. Thank you all for joining.
Yes, thank you. Have a good evening, everyone.
Have a
You guys-
great evening.
Good evening.
Thanks, guys. Have a good one.
Bye.